Yeah, that's one of the things which we talk to our clients about is which way the skew is. And when people say geopolitical skew, it's really going to be on waterborne crude and Brent and all your Middle East crudes. They kind of fall in that basket, while TI kind of lags where that comes into picture. And then, of course, you max out on exports. So that's one more thing. And then you have potentially the landlocked potential of TI. So you can't get it to where you need to be just based on the contract. And then on the downside, oftentimes it is TI, which has the skew to the downside because if you have any disruptions or pipeline issues, then you get, again, the landlocked part of TI, which makes it break down. So Brent has that skew up, and then TI has the potential for disruption and skew down.
Welcome to the Energy Desk, a podcast from Mobius Risk Group. In this series, we break down the macro forces and fundamental trends shaping global energy markets. We cover everything from geopolitics and policy to supply, demand, and the price risks that we're watching behind the scenes. Each episode is designed to cut through the noise and give you clear, actionable insight into what's driving today's energy landscape and what it means for what comes next. You can follow the show wherever you get your podcasts. You can share feedback or ask questions by emailing podcast@mobiusriskgroup.com. Let's get started. All right. Mohit, welcome back to the Energy Desk. Sitting here roughly 3 weeks since our last update, and it is Monday, March 30th. So plenty of developments to cover. Yeah, how are you doing down in Houston?
Good. Getting warmer here. So good for me.
Yeah.
I like warmer.
Yeah. Good for Mohit, not as good for natural gas, but that's maybe a topic for another episode. I think today we wanted to do a little update on the Middle East and broader kind of crude complex focused developments without getting into the kind of news coverage and all the associated details with everything. And if there are listeners who are interested in digging into the information that we're putting out on the subject, I'd encourage you to check out our research publication. You can get the links to that at mobiusriskgroup.com. But today, instead, there's really kind of a handful of questions that we've been getting that I think can be grouped into a few different topics, and addressing those kind of going down the list would be the headline kind of news information versus maybe the reality that we're seeing from a data perspective. And then getting more into kind of the nitty gritty on the curve impacts, which products or benchmarks are being the most affected, and some of the most important details for folks to keep in mind as this gets into its basically fourth week. So
I think one of the big things is, I know you and I have talked about this, is the amount of noise has increased exponentially, and it's really important to dig in and figure out what the real signals are and what that reality is, because I think with AI, there's so much more realistic fake news. So
it's been an information war in many different ways. And as you just mentioned there, the AI side of it makes it particularly complicated, deciphering, is this video real or fake? And I think the velocity of information is definitely a step change from where we were a year ago even. So, and that's been, I think, that plays into what we should talk about today, because I think that the information war and this kind of headline fatigue, you're starting to see that play out in the kind of, the broader market where, funds are starting to say, okay, I'm going to just go to the exit and kind of await more clear directional cues on how this is going to end up, because the verbal intervention that we're getting from both sides, the US, from Iran, the discrepancies between public commentary versus this back channel private dialogue, all of that, I think, is starting to play into quite a bit of daily actions. I think maybe just to start, I'll do a brief kind of highlight of where things are sitting today. And obviously this is subject to change quickly. But for the kind of production impacts in the region, we have between the upper 8 to low 10 million a day of production curtailments, and those are ebbing and flowing. So that's just a ballpark number. On the kind of actual supply impacts, this is one addressing one of the most important questions, or one of the most relevant questions, is what is the actual supply impact? And this is when we start to dissect some of the numbers. I won't go super deep, but when we look at Strait of Hormuz disruptions, obviously there is a tangible impact to those. The two kind of levers that I want to point out. So Saudi Arabia has started ramping their alternative export routes to the Red Sea. So that east-west pipeline, they upgraded it to 7 million a day capacity. They are now at capacity, and the exports from Yanbu and the Red Sea terminals have capacity about 5 million a day, and that's essentially where we're at now. So last week they got it to an average about 4.6 million a day. And I think this week will be pretty close to that 5 million a day mark on average. And so starting to see quite a bit of activity there. And then for the UAE, they bounced back from kind of the middle of the month where they had a series of 3 different drone attacks on Fujairah. They have since ramped exports or loadings from Fujairah to the highest that they've been in, I believe, at least a year. So they're running kind of that 1.8 to 1.9 million a day mark last week. And if they're able to hold that, then that will be just kind of incremental supply that would otherwise be trapped. Iraq, Kuwait, Bahrain. I mean, Bahrain kind of nominal in the whole calculation, but Iraq and Kuwait are really bearing the brunt of the disruption. Iraqi curtailments kind of on the order of 3 to 3.3 million a day, and Kuwait, kind of the 1.52 mark, depending on the data. So you have real impacts, but the real supply picture is definitely different than, or less severe than, some of the kind of 15 plus million a day numbers that get thrown around often in the media. So I think that's just kind of worth keeping in mind, that one, the data shows a pretty significant difference from headline commentary, but then also you have the other complicating factor with the Strait of Hormuz tankers themselves, where you have basically the entire fleet turning off their AIS transponders. And so if you have vessels passing through, they're going through dark, so to speak. And then you have now the Iran permitted transits for basically the vessels not affiliated with hostile countries. And so a lot of that has been kind of the Pakistan or the Japan, China, India. They've all had a series where they've been able to get tankers through. So I think just pointing that out. So the Japan, China, and India were responsible for essentially 2/3 of Strait of Hormuz tanker flows through 2025. So those are your big players right there. And if they're able to start flowing normally, or not normally, but semi-normally, then I think that the picture starts to be less significant than is reflected in commentary. Do you have any addition to that before we kind of get into some of the others on the list?
No, that's actually a very good point, is once you start getting these ships out, it takes that tail out of that concern, so to say. And you start seeing that. We touch on it later, but that's kind of what you start seeing in the call skew or the backwardation. And it's like you have to keep feeding this kind of a curve every day with really bullish news. Otherwise, it's hard to sustain both the vol and the price backwardation.
Right. It's a hungry animal. And then, final, just kind of brief ones on the supply side. So 2 kind of stock supply sources. One, you have U.S. granting sanctions waivers for floating barrels from Iran, and barrels that were on water by March 12th from Russia. So I'm just kind of rough order of magnitude for those. For the Russian seaborne crude, that's roughly 160 million barrels as of last week. And then the barrels from Iran, you have roughly 30 to 40 million barrels of floating, so stationary. And then you have another roughly 150, 160 million that were in transit as of last week. So that's a little bit of a buffer, primarily going to be to the benefit of kind of Asia writ large, where a lot of those barrels were already located, and definitely a buffer for, say, the Indian refiners who had needed an alternative kind of right away. And then adding to that, you had the IEA coordinated release where they said 400 million. ended up being a little bit more than that when you had some industry additions to it, but 426 million. And that's broken with 71%, so 301 million barrels of crude and 25 million barrels of products. And today, some more commentary from G7 finance ministers saying, hey, we're considering more. So we don't know what that might look like. But that translates to kind of that 3 to 4 million a day on their average release rate. So you're still running a shortfall if you're running the numbers against the Strait of Hormuz and the broader regional flows, but it's definitely less significant than where we were. And I think getting final point on all of that is that one of the questions that we've been getting quite a bit is why is this scenario where you have such, worst supply disruption, as the IEA says, worst supply disruption in history, why is this not being reflected in price like we saw a couple of years ago with the Russia situation? And I think just kind of the very direct answer to that is that the starting position of this year is vastly different than where we were before. So stocks and onshore stocks were elevated for most regions outside the US. Since really the end of last year, US onshore crude has been building quite aggressively. We're now above median levels relative to the last decade seasonally. China has over 1.2 billion barrels in their onshore between commercial and strategic. So there's definitely more of a buffer. And I think that's also just kind of the quick takeaway to keep in mind for anybody listening with that same question. Now, I think
Destruction, right? I mean,
right,
you've got what, depending on the day, $70, $80 cracks on diesel, 35 gasoline, and it's much worse when you go to Asia.
right, right. And I think that's really where we should maybe go now is where have we seen the impacts on, the various curves for say WTI, Brent, and then also products. So maybe if you want to kick that off from your eyes.
Yeah. I mean, like I mentioned, we've been seeing cracks on distillate here gradually going from 30, 40, then they just started ripping and they've been in the north of 70 range. So think about $100 crude and $70 diesel. That's wholesale at 170, 180 bucks. So it's starting to see at the pump as well because now you go by and you say, wow, I didn't realize it had gone up that much. I think you're going to start seeing some demand destruction from that. And then I was reading overnight, I think Asian jet had hit 225. And jet was something which was pretty much an oversupply everywhere, but it's just hard to get it to places. And now you're starting to scramble. And I think it's the surety of supply which people are going for. We're reading about and talking to people, and even things like West African crudes, which normally trade at a small premium, have been, trading at double
Double
digit
digit.
premiums. And Middle East crude, of course, is much stronger, and people are willing to go further out to secure supply.
Right. And the demand destruction and just kind of maybe rough order of magnitude on that. How much, I guess, on a percentage basis or other, if you see fit, what type of offsetting impact would you expect to see for something like that, maybe regionally or global?
I think it's hard to put a number because it's not just the price. In Asia, I talk home and we're starting to see LPG shortage in India, and they're recommending, and it's pretty soon going to be a policy thing where you can't drive or can't do some of the things which would be using the fuels. So once you start adding actual demand destruction based on price and the policy based destruction, I think you could offset at least a third of it if this sustains for 2 to 3 months. It takes a little longer to go through, but it's also sticky. Prices and retail prices on fuels go up very quickly, but from having spent some time on the other side and dealing with clients, they bring it down very slowly after. So that's where most of their money is made, is they're very slow to bring those prices down when they come back. So I think once you get to those levels, the demand destruction will stay for a while.
Yeah. Yeah. And I think, as you pointed out, you've got, as of today, the prompt diesel crack for the US for NYMEX just under $74. So with crude front month settling just under 103, it's definitely demand destruction territory. And I think, as we look at Brent versus WTI. That's been another question that we've been getting quite a bit of. We've had basically that spread blow out quite a bit in the last few weeks. And maybe if you want to touch on why that is. And
Yeah, that's one of the things which we talk to our clients about is which way the skew is. And when people say geopolitical skew, it's really going to be on waterborne crude and Brent and all your Middle East crudes. They kind of fall in that basket, while TI kind of lags where that comes into picture. And then, of course, you max out on exports. So that's one more thing. And then you have potentially the landlocked potential of TI. So you can't get it to where you need to be just based on the contract. And then on the downside, oftentimes it is TI, which has the skew to the downside because if you have any disruptions or pipeline issues, then you get, again, the landlocked part of TI, which makes it break down. So Brent has that skew up, and then TI has the potential for disruption and skew down. So you're seeing that. And that's not even counting things like dated Brent, because that's also been very, very
yeah, yeah, I think that's been interesting. And I think as we look at the product side, we already discussed that. But as we look at kind of the inventory picture, that's been an interesting one to see the regional dislocations there. So really the US has been buffered, obviously, by quite a bit of this with our domestic capacity, and refineries have been running quite strong, but exports have not really been ticking up in the way that maybe some might have expected. But I think there may be a lag to that if this is delayed by, or this is ongoing for another several weeks, then that starts to maybe fit into the window where you would see the combined effect of stronger U.S. exports feeding into inventory changes and things like that. So I think that's maybe
yeah. And then if you've got the issue of stranded ships in the Persian Gulf,
right,
so
right.
you have less capacity to move barrels from where they are to where they need to be. And I mean, just in terms of numbers, I was looking before we came in here. Interesting that crude is about 22 million higher than where we were last year at this time.
For
Pretty strong,
U.S.
because yeah, for U.S. crude.
Yeah, yeah. Yeah, and that's been consistent. Like last week, we've had a streak, I guess, of 2 to 3 bearish builds in U.S. onshore inventories for the last little bit here. So now firmly over that median level, like we mentioned. And then as we kind of look further at potential scenarios, just to kind of keep in mind, I think there's been quite a few questions on, I guess, there's several angles of attack to this kind of similar theme, but the potential for further escalation from here, feeding the bear or feeding the bull, either direction.
Mm-hmm.
The obvious one, I think, to look out for is the Red Sea. So as Strait of Hormuz, disruptions, Saudi rerouting their exports to the Red Sea. That is another choke point for that crude to get to Asia and all these other regions. If the Houthis, who this weekend said that they're going to support Iran in some capacity, but they're not going to begin attacking Red Sea vessels, they have started launching missiles at Israel, but again, not attacking the Red Sea. If you see that start to kick up again, where you get potential targeting of whether it's the vessels or Saudi Arabia's export infrastructure or the pipeline, East-West pipeline, any of that would be a massive, massive escalation. And related to that, UAE as well. And then the Strait of Hormuz, that's really the big question. How is this going to resolve? Iran publicly, kind of in line with what we mentioned with this public versus back channel dialogue, the public themes of what they've been saying in Iran affiliated media or on X, anything like that, is really they want to have kind of a grip on Strait of Hormuz tanker flows. And I think that's really probably the big question for a lot of the market right now is how does this resolve and what potential solutions are there? And I'll highlight one that I think hasn't really gotten as much coverage as maybe it warrants in my mind, but the Pakistani kind of influence over Iran, and then the mediation between US and other Gulf states and Iran in these back channel discussions. One of the topics that was floated at this weekend's meetings between Pakistan, Egypt, Turkey, and Saudi Arabia was the potential for this kind of consortium-based Strait of Hormuz management, similar to the Suez Canal. And that, to me, seems like one of the strongest candidates for resolving this, where you have maybe some regional influence over that. What else are you watching related to, Strait of Hormuz, but also some of these escalatory or de-escalatory risks that might be lurking?
Yeah, I think that's probably one of the mechanisms which will get to a face saving and yet practical solution, because neither side can officially claim a win, and the loser, I mean, because if they do, then the loser just gets obliterated at home. So something where it becomes a consortium management thing, it's like, okay, kind of agreed to do this and so on. But I think there's just still too many non-Strait of Hormuz issues which don't get resolved with that. Nuclear material, the missile making, and proxies. So there's still plenty of stuff which is unresolved.
There is plenty of that. And I think the fracturing of the IRGC and the leadership surrounding kind of the old Iran regime adds to that complexity. And I think the final point that I want to kind of maybe leave this on is a question that we've been getting a lot of as well, is how, say we do get a resolution, how does that affect the curve? Because we've had front centric price action, obviously all the risk is concentrated at the front. But when you have the IEA coordinated stock release, you're eating the kind of sovereign stocks, you're eating into industry stocks, and then you also are eating into the kind of floating storage surplus, oil and water surplus that we've had. So you definitely would exit the conflict with a vastly different supply landscape than we started, where the entire world was, it's oversupply first half of 2026, which we have many thoughts on that. We've shared some of those if you want to go back and listen. But I think it's a fair question. How does this reflect in the forward curve when you see it, I guess?
It's a tough one, because on one side you have selling pressure in the front, which will propagate. The other is just looking at positioning. I mean, if you look at what swap dealers have done, which reflects producer selling, there's been massive selling in the backs because most of them were pretty well hedged in the front. So there's a lot of selling that has already happened.
Mm-hmm.
And now if the buying goes away, and then the length that has come into the spec market starts exiting, there can be quite a bit of pressure to the downside before it all kind of rebalances. And then the rebalancing depends on how long some of these outages are really, I mean, does it take 3 months to get back? How much permanent damage is there? Do we have to clear debris from the Gulf? I mean, there's a million questions which matter. Then once the selling is kind of done, it's kind of when people will reevaluate, and then it's kind of a fresh start.
Yeah,
There's a lot of
definitely.
selling that can happen.
Definitely seems like there's a lot of selling that can happen. A lot of, as we mentioned, the speculators have just gone to the sidelines. Speculative open interest dropping for a lot of the benchmarks. So yeah, it'll be interesting to see. And I think on the production returning, that's a most likely multi-month process to get back to full capacity for most of these countries, if not longer for Iraq or Kuwait, some of the most affected. So yeah, it'll definitely be interesting. Seems like the floor would get, definitely more support from where we were at the start of the year. The other unknown is how that also affects kind of the Middle Eastern writ large strategy, which tends to favor the high fronts, low backs. And so, that all plays into it. And there's not one single answer. There's, an infinite number of outcomes that can happen here. So I won't get too far into that, but I think that's a good coverage of the last couple of weeks where we sit now. And if there are any specific questions, please reach out and be happy to discuss on a more kind of portfolio specific basis what the opportunities and risks are. Anything else that you want to add before we sign it off?
Yep, I think we got a good coverage of what's been going on.
All right. Awesome. Well, I'll see you next time, probably with
Yeah,
plenty more to discuss.
I'm sure. Thanks
All
again,
right.
Alex. Appreciate it.
All right. Thanks. Thanks for joining us on the Energy Desk. Please keep in mind this commentary contains our views and opinions and is based on information from sources we believe are reliable. This commentary is for informational purposes, should not be considered investment advice, and is not intended as an offer or solicitation with respect to the purchase and sale of commodity interests or to serve as the basis for one to decide to execute derivatives or other transactions. This commentary is not considered promotional material.